Hi everybody, John Schneider here with the Isthmus Group, and today we're going to be talking about how to analyze a fix and flip property. You know, what separates investors who actually make money and others who are just breaking even or maybe even losing money is proper analysis. And it's not about finding the cheapest property or having the fantastic contractor that does everything really cheaply. It's about knowing how to properly analyze your fix and flip so that you can make an offer with confidence. And today I'm going to break down what that exactly looks like and what a great analysis really includes and why each piece really matters. And then how to put it all together so you can walk away with a deal with clarity and confidence and know that it's going to likely turn a profit. So first, let's clear some things up. A lot of people think analyzing a flip means finding a beat up house and guessing what it might sell for and hoping that the numbers all work out. The bottom line is that's not an analysis, that's basically gambling. A proper fix and flip analysis is a complete financial picture from day one of closing, or day one of analysis to closing it. It answers three core questions. One, what will this property really be worth after it's fully renovated? Two, how much will it cost me to buy it, fix it, and carry it? And three, what's the anticipated profit when I actually walk away? Now, when you can answer all three of these real numbers, you're analyzing. Until then, you're just guessing. Everything starts with a flip with the number one value of an after repaired value, or ARV. This is what the property will be worth once renovations are complete and it hits the market. Here's what a lot of beginners start to make their first mistakes. They fall in love with a property and they inflate the ARV to make a deal work on paper. Don't do that. The ARV has to be grounded in reality. To find it, you have to look at comparable sales, recently sold properties in the same neighborhood, similar square footage with similar condition, and ideally sold within the last 90 days. Pull at least 3 to 5 comparables and find a realistic range your finished property would land. Your ARV is not the best case scenario number. It's the most defensible number because when you go to sell on the market doesn't care what you spent. It only cares what the comparable homes are selling for. So you need to build your entire analysis around a relatively conservative ARV, and it'll protect yourself from the downside of that potential investment. Now, the other side is, what is the deal going to cost you when you finish it? This is where most people are underestimating the cost. They don't know exactly how to look at that flip and make it profitable and how that paper turns into a loss in real life. A proper flip analysis accounts for every single cost bucket: the purchase price, what you pay to acquire the property, closing costs on the purchase, typically 1 to 3% of the purchase price, renovation costs, get a detailed scope of the work and the contractor bids, and not a rough guess on that, and then your holding costs. Every month you own this property, it costs you money. That includes loan interest, property taxes, insurance, utilities. And a typical flip takes about 3 to 6 months to remodel, and every month that's costing you more money. And then there's the selling costs like real estate commissions, closing costs, and that typically can cost you between 8 and 10% of the ARV. Then there's your contingency budget, which is about 10 to 15% depending on the size of the renovation. And you make sure you add those buffers in. Now you add all that up and your total project cost is every dollar you spend between the day you close and the day you sell that property. Now, before you get onto profit, let me give you a quick filter that experienced flippers are using to screen deals fast. It's called the 70% rule. And it says your maximum purchase price should be no more than 70% of your ARV minus your estimated renovation cost. That means max purchase price equals ARV times 0.7 minus the renovation cost. So if the ARV is $300,000, renovations will cost roughly $50,000. Your offer is $160,000. That 30% buffer is what covers your holding costs, selling costs, and your profit margin. Does the 70% rule apply to every market? No. It's an inexpensive markets. Investors expensive markets, they'll stretch to 75 to 80%. And it's kind of a gut check to see how far you can go because they may be more competitive markets that you have to pay more. Now that number is not for everyone, and everybody's profit is a little different. But it's a simple ARV minus total project cost equals your net profit. But profit alone doesn't tell you the whole story. You also want to know your return on investment, or your ROI. Divide your net profit by your total cash invested in the deal, then multiply it by 100. Most experienced flippers target a minimum net profit of $25,000 to $30,000 per deal and a return on investment of at least 15 to 20%. And that, again, varies on your market and how fast deals move. Sometimes you have to pay a little bit more, accept a little bit lower profit margin. If you're getting $40,000 and it takes 8 months rather than, $25,000 is in 3 months, you're turning that money over faster. So you're able to get more return in a shorter timeline sometimes when you're able to turn properties over. So you have to be willing to accept the way that the market is transitioning your investment to get a better return on your number. Otherwise, you may never find a property at a price that you're going to be able to purchase at because too many people are buying it before you get a chance to do that. So you're looking at other things like the market trends. Are the markets cooling off? Are they heating up in that area? You can look at how long properties are taking to sell in that area. Is it going up or going down? And we need to make sure that we understand that market completely. Most people make quick judgment decisions in this area and are losing because they're not fully understanding their market. And they don't have a defensible ARV, a defensible timeline, a defensible budget. So using these rules to calculate and predict your net profit is a very good way for you to get good at making money as a fix and flip investor. Now, I hope this helped out. You can subscribe. You can look. We're going to be talking about different advantages and disadvantages of holding real estate. But ultimately, this takes practice. And if you're going to be practicing real estate, it's like a medical practice. The doctor goes in every day and he does what he has to do to understand how to become a better doctor. And that is the same with real estate. We need to practice our real estate investment. We need to analyze properties every day, and we need to understand what it is that we need to do every day to make ourselves sharper and more equipped to do real estate investment in our market. So go ahead, keep your practice up, analyze those property, analyze those deals. We look forward to talking with you again. Again, John Schneider with the Isthmus Group and the Living in Midwest Life real estate team. Subscribe below. We'd love to connect with you and talk to you about how you can do better investment in your market.